Hey guys, thanks for joining back into the Cryptoverse. Today we're going to be talking about risk management in Ethereum. If you guys like this content, please subscribe to the channel, turn your notifications on, and like the video. And check out the description below if you want to join the Telegram channel or my Twitter. And if you want to support me, you can do that with Patreon or however you want if you feel inclined to do so. So what we're going to go over is risk management in Ethereum. We did this with Bitcoin yesterday, so naturally I like to follow it up with a video on Ethereum. And you can see that we have the price of Ethereum on a log scale and the date. And then we have a color-coded dimension of the risk. And the risk is a fairly complicated equation I made. I'm not going to post it here. I am trying to get this up on my website so you guys can see it in real time. I will be showing at the end of this video another equation that you can use that more or less gives you the same thing with some differences. But anyways, we're basically gonna step through this piecemeal and try to really understand how we manage risk in Ethereum. So you can see that it goes from 0 to 1. And when the risk is 0, it means historically it's the best time to buy, and when it's 1, historically it's the best time to sell. And so far, there hasn't really been a ton of data for Ethereum, but there has for Bitcoin, and we will be making some side-by-side comparisons. But we just work with what we have. That's all we can do. So you can see that historically, when it gets into the darker blue regions, that's when you want to be buying. And when it gets into, say, risks of 0.6, 7, 8, 9, and 1, you want to start selling. It's not entirely clear-cut, but more or less that's what you want to do. If we take the color coding out of it and just plot the risk on a secondary y-axis, you can see that really it's quite informative because it starts peaking. The risk starts peaking before you actually hit this peak, which is nice. And maybe it corresponds exactly to the top, but you can see it's really going up before the price peaks. So the price is the blue one over here, the risk is the orange one over here. So that's just something important to consider, because if it were a lagging indicator, it would not be nearly as useful. So how do we dollar cost average our way into an asset and out? So with Bitcoin, I just wanted to pull up, this is what Bitcoin's chart look like. So, when you're buying between, say, 0 and 0.3, historically you're doing quite well, and you're not really spending a whole lot of time below those levels. If you could just stay disciplined and buy at these levels, then you would actually be doing quite well. Now with Ethereum, we've only recently come down our first time into this risk level of between 0 and 0 and 0.2 or so. So we've come down to this level. You can see that Bitcoin's done it several times here, here, and here. And now Ethereum has done it, and I know many people were buying over here. And it's important to distinguish between the smart money and the dumb money. Again, I've said it in many videos. The smart money comes in when that last person is capitulating, when it doesn't seem intuitive to enter the market. The dumb money comes in when you have a lot of people watching the news and they see Ethereum or Bitcoin is skyrocketing and it seems obvious to invest because of how fast it's going up. That's the dumb money coming in. You're going to be selling to that money. Okay, you're not buying then, you're selling then. If you're buying then you're just doing something wrong, and you're not making a long-term investment. You're just speculating over a couple days. So I'm not saying you can't make money doing that, but the real money historically in crypto, the real money is historically made in the bear market. And I mean investing in the bear market. I've said this quote before, but it's true. Bull markets can make you some money, but bear markets can make you rich. If you can invest in the bear market and the asset does take off, which if you're watching this video, I'm more or less assuming you see the long-term potential of Ethereum, then now is the time to invest. Maybe not right this minute, but in general, when these risk levels are lower, say between 0 and 0.3, those are the best times to be getting into the market. So if we step through, what I do is I have buy regions where I dollar cost average my way in, and then I dollar cost average my way out. Now, not every dollar cost average method is created equally. If you just do the same amount every month, then it's an okay method. But a better method, in my opinion, is to look at the risk each month and see where it is. And if it's lower than it was the previous month, then you want to put in more this month because your risk has gone down. And it's all about managing your risk. If you can offload some of that risk, if your risk gets too high, you might want to offload some of it by selling it and maybe converting it to fiat or to another cryptocurrency. If there's another one that has, say, a lower risk at the time and you want to form more of a longer term position in that coin. But this basically is where I'm putting in the most money into Ethereum. I'm dollar cost averaging the most, and then I have another couple buy regions as well where I continue to dollar cost average. It's just not as much. So I stick to that pretty well, and it can be hard sometimes to stay disciplined in the market, but I think it's very important to set your goals now so that later you can remind yourself during the euphoric phase that when you were thinking rationally, you made these decisions, and now that you're thinking irrationally because it's a euphoric mania phase, you need to stick to your decisions that you made at a rational time in the market. So remember that. So then we have a gray region, and this region more or less corresponds to, it could go either way, at least for me. Maybe some of you guys think that it's okay to buy all the way up to risk levels of 0.6, and if that's what you want to do, that is perfectly fine. This is just what I'm doing. Generally in here, it depends on the market. When we were coming down from 1400, the market did not appear healthy at all. The bear market was it emulated, many of the past Bitcoin bear markets, and the momentum was going down. On the other hand, when we're going up, it seems like maybe it's a better time it might be a good time to continue buying. I mean, over here you can see we actually hit 0.3 twice and then went off. I don't think we're about to skyrocket or anything. I think that this next cycle is going to be long and drawn out. That doesn't mean we're not going to see gains of 2 or 3x in a month. I mean, that's still entirely possible. But if you're looking for those like 50x gains or something like that, if it does happen, I don't think it'll happen for another 2 or 3 years. And that's just based off looking at days since the bottom for Bitcoin and extrapolating out and looking at the fact that each cycle seems to be getting longer, and that we are not necessarily on a 4-year cycle. Personally, I don't think we're on a 4-year cycle. I would love it if we are, because then we can sell sooner, but I don't think that's the case. I think likely the next bull market isn't until at least 2022. So just keep that in mind. Just be patient and wait. And remember, everything I say comes with its own level of risk itself. I could be wrong about everything. So remember that. And I'll remind you that this YouTube channel is meant for more long-term positioning and not day trading or short-term. I'm not going to put up clickbait videos that say things that, where my emotions change on a daily basis. I have what I think in my head, and I'm sticking to them, and I will be sticking to them for the next several years because I really believe that Ethereum has a bright future ahead of it. And because I believe that, then it's almost a good thing if the price goes down in the short term, because then I can accumulate more Ethereum during this time, in which case I really don't think this time is ultimately going to be that relevant in the grand scheme. I just think it's, we might go up a little bit here and there, but ultimately it's just noise compared to what I think might come down the road. So if we go down, for me, that's fine. If we enter this buy zone over here, I will definitely be buying. Note that the risk can go down even if the price doesn't in the way I've defined it, so keep that in mind. Basically, I have, as I said, I have these 3 buy zones, and then I have this gray area where sometimes I'm buying, sometimes I'm selling. And then we have sell zone 1, 2, 3, 4, and 5. And note that these sell zones You can do it however you want to, but the way I do it is I sell 20% at each level. And some of you probably think, well, if you do that, you're missing out on a lot of potential gains during one of these extended run-ups, like where the market is just going crazy. But the point of it is we didn't know that we were going to continue going up like this. And in fact, if you by selling 20% each time, it helps offset some of your risk, and you hope that it goes higher so that you can continue selling more at a higher price. But you're also happy if it goes lower, because then you sold near the top. So it works both ways. And over here, if you had gone with this method, you would have sold recently when we hit that risk level of between 0.4 and 0.5. You would have sold only 20% if you did what I do. Maybe some of you guys are want to do more, and you can do, say, 50 or 60%, or however much you want to do, and if it works out for you, great. But you also have to remember that there is some potential opportunity cost to exiting, say, your entire position. But if you're completely confident in it, go for it. So anyways, right now we're in this gray region where we're not, it's not, as far as the market is concerned, a lot of people are waiting to see. Bitcoin has had quite a year, going from 31 or the 3,000s up to all the way up to 14,000, and now we're sitting at a 50% loss from 14,000 and around 7,000. So it's had quite a year. So we will continue to update these charts. I'm not going to leave you guys hanging. I will try to get it up on my website where it's updating live, so you guys can follow it and make your own informed decisions. Make sure you just use this as a tool for your own research. So anyways, one of the things I want to point out on this graph is that if you do sell 20% on the way up, then there's two ways you can do it. You can think of it in terms of the U.S. dollar or fiat or whatever you want to, whatever you use, or you can also think of it in terms of Ethereum. So if you sell, say, 20% of your Ethereum stack every level, then in the last level you'll be selling everything. Another way to do it is you sell 20% in U.S. dollars, and then as you go up, if the price of Ethereum keeps going up, then you would still have some, because you would just be selling 20% of what that U.S. dollar costs, or that U.S. dollar value is, that during that risk level. In which case, it would allow you to potentially sell in this final region over here. So this is the risk. So this corresponds to this axis over here. So that would have been corresponding to this peak over here. And then when it comes down, if you're comfortable buying between risks of, say, 0.4 and 0.5, then maybe you pick up a little bit more. Maybe you're comfortable buying at this region. I'm not saying I've never bought that region. I have. And it works out sometimes, and it doesn't work out other times. But again, if you just sell 20% of the total value in U.S. dollars or fiat, then you would still have some in your stack, and you would still be holding on to some. And if you are okay with higher levels of risk, let's say you say that your buy zones are all the way up to 0.6, and if you were selling in, say, these three regions up here, and then it went back to 0.6, then you could pick more up. It's all about managing your own level of risk, what level of risk you're okay with, when you want to offset some of that risk, etc. So you need to think of this in terms of risk management, because ultimately that is what it boils down to. You don't want to be caught holding on to an asset and then watching it go, 100x in a year, to just watch it crash by 80 to 90% the next year. Many of you guys have experienced that. Many of us have been the dumb money in the past. Let's hope those times are over. It's time to be the smart money. If you haven't already been the smart money, it's time to become the smart money. Invest when the market is down, is what I do, and sell when the news is covering it every day. Sell when everyone is getting into the market. Sell to the dumb money. That is how this should work. So again, I just wanted to reiterate, this is how Bitcoin looked. So this is Ethereum, this is Bitcoin with the same buy zones, gray areas, and sell zones. So you'd be buying Bitcoin in these regions, potentially buying it in these regions, and then selling it in these regions on the way up. That's typically what I do. But obviously there are going to be some imperfections with it, because it is just it's just an empirical equation that has its own shortcomings. Potentially one shortcoming is showing how you can see that the risk each time gets lower and lower. So if it were to continue that, then maybe the risk ultimately is will only ever peak at 0.6, much further down the road. That still could be a Bitcoin price of $100,000. The reason it would only be 0.6 is if it just takes it a long time to get there, and if Bitcoin moves up more methodically and slower than it has in the past. So there is another chart that I do have that I will be showing in future videos, where I actually account for later market cycles, and then it ultimately allows these peaks to go to 1 for the risk. But I'm not going to go over that in this video. Using say that chart and this chart can really help determine your buys, and then the other one can really help determine your sells. Or you can just use one chart to determine everything. It's fine, really. Just the moral of this narrative is more to say, there is risk associated with crypto. You can define these risks and then define what they are during a rational time in the market, and then stick to them during an irrational time. It's simple. Just try to do that. If we continue to move on, you can see here we're comparing Bitcoin to Ethereum. We're going back to this color-coded chart, and you can see how similar they are. I mean, to me, they're eerily similar. If you look at this run up with Ethereum, goes back down, second run up, looks very similar to Bitcoin, up, down, second run up, then bear market. I've reiterated that I think a lot of altcoins are emulating Bitcoin in the last market cycle. So I do think that there's a good chance that we're not going to drop back down. I think we might just kind of flatten out here and spend an extended period of time just building our support regions. But ultimately, I don't know what's going to happen. I mean, if the price does drop, then I'll just buy more. And if the price goes up, then I will start considering when I need to start selling, say, 20%. That is ultimately where I am. Now, as I mentioned, I do think this next cycle is going to be somewhat extended. I think it'll likely be 2022 plus or minus 1 year. When we would have another mania phase if we continue to repeat history. So we will obviously be keeping an eye on that. I really don't anticipate selling 20% anytime soon. I feel like it's going to really take us a while to build back up. I mean, obviously selling 20% here, I don't think we're going to pop right back up. But it's obviously anything is possible. So let us just I want to wrap this video up. I know it's been going on for a while. So one of the things I want to note is that many of you are probably frustrated that I'm not showing the equation. As I mentioned, I will definitely put it on my website. But if you're interested in just exploring various levels of risk, I found another way that you can more or less get what I have, but there are some shortcomings to it. So you can see this is what I have, and then this is another method. So I'm going to toggle between them so you can see the differences. And the reason I like my method is because it becomes clear where the buy points are, and then with this one it's not quite so clear. But regardless, the reason why this method can be useful to you is because all it is dividing the 50-day moving average by the 50-week moving average. And the reason that works is because you're dividing, say, a short-term thing by a long-term, and then you're normalizing it, so you're dividing it by the maximum of the short over the long term. And the reason that works is because you're measuring how far away you are from a longer-term base, and the further away you get, the higher your risk. It's fairly simple. The downside is it becomes more of a lagging indicator because you're just taking into account the moving average, and you can see here you know, this peaks after this peak, this peaks after this peak. So it's not quite as useful as this one, which it peaks, you know, as the other one is peaking. And it goes up, you can see it spiking before the price peaks, which is very nice. It becomes more helpful during those times. So, you know, again, if you guys like this content, please subscribe. And if you want to support me, just check out the description below. I do try to post some of this content into Twitter and Telegram, and I post everything onto Patreon. So just let me know what you guys think in the comments below. If you guys like this content, if you want to see more of it, if you guys like, you know, looking at things from a risk management perspective, and let me know what you guys think. I really would like to hear your comments. Anyways, that's it for this video. Until next time, bye.